Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is FOMC Live. Today, we're going to go ahead and cover Jay Powell's press conference, one of his last pressers of his career at the Fed. We're going to go ahead and give you live coverage of that. A little bit of critiques, too. There was some interesting things that were in the new Fed statement that were, I don't know if they were expected, but I think everybody pretty much knew that you weren't going to see an interest rate cut at any capacity at all, even though it was promised coming into this year that we were going to get multiple rate cuts probably by now. We haven't got one yet, and we're being priced with our first rate cut out in September. So we're going to go ahead and take a look at this presser. I think it's going to be interesting. I think that we've got an interesting type of a deal, and that's the word of the day is interesting, because we're watching all these big events. We're watching WTI crude oil out of the corner of my eye. A little bit of a sell-off here since we've got the announcement, but we've got markets that are just in turmoil right now. We're in angst. I believe it's day 18 of the U.S.-Iran-Israel war. That is the number one market driver in the world. There's no question about it. Even today, typically when the Fed speaks, you see volatility. Really didn't see very much. I mean, let's get right out to price action here. I'm on our MT5 charts. You can see that we got a little bit of price action right there, but it was very choppy. These markets don't have a direction, and sort of trade them at your own peril. Sort of a fascinating environment that we're in, though. When the United States Federal Reserve Chairman gives a press conference, there will be volatility. That's the old saying, there will be blood. Well, there will be blood. The press is going to come after Powell with both barrels. Powell is going to defer pretty much all blame, any and all blame for persistent inflation. He's going to go ahead and defer that to the administration and the war with Iran. That's pretty much a guarantee of what's going to happen. We did have some other key events that I do want to cover today, and then also we'll take a little bit of a look at that 9 EMA, probably trade that one live, maybe some Fibonacci's as well. But it should be a lot of fun, so I'm glad that everybody joined me. Tina Jane, good to see you. Tina, welcome. Jason Maxson, yeah, Shane, yeah, Jay. No, I think we're in great shape today. I feel pretty good about probably getting an opportunity or two to trade. The gold, we talked a lot about gold. Gold had a big washout, sort of the one that we were thinking of, and it just came a few days too late. Let's see, Bobby Bob, Coach, hi, Coach, how do we trade stocks? Man, that's the $1 million question, Bobby. If I knew, I'd tell you. No, I'm just kidding. Stocks are going to be, it's a long conversation, but essentially you're going to be wanting to look more sectoral and looking at fundamentals and fall back on your technicals. It's real similar to what we do here in the trading room, but that's a long conversation, how to trade stocks. We'll go over some stock indices, though, that's for sure. Let me see. Naomi, good to see you. Naomi, welcome. Pack-up almost blew a count. Well, almost. Almost doesn't really matter. As long as you didn't blow it, you got some ammo left to trade with. That's what it's all about. Be sure that you always save a little bit. As he should, a complete mess. Well, yeah, DAH, interesting. Fascinating, interesting stuff. 1906, what's good, Shane? Well, a lot of things are good in life. A lot of things aren't so good. But we're going to do the best we can to see if we can spot a few opportunities. Steve Francis, good to see you. Steve Francis and Tuku, always a pleasure. Callie Buckle, good to see you. Callie, welcome. All right, guys, let's go ahead and there's one level that I do want to outline before we get started here. A trade update on our Euro USD. We're really nowhere near this level, but we do need to talk about it just briefly because it may come into play depending on what Jay Powell says. 113.54, we really like that zone on this monthly retracement level. Essentially, we were looking right at 113.60s. Right now, we're trading about 115s. Shouldn't surprise anybody. We are right at that monthly 13-month moving average, which is a big deal to me personally. So I always like to outline exactly where those things are at on my chart. And we're just going to wait and see what happens with price action. But you can see right there, we're trading right at that moving average, which is present at 1502, 115.02. We're trading 115.09s. Interesting strategy. If you wanted to buy and hold it from right here, I probably wouldn't blame you. But I think that it's incredibly risky to do anything ahead of Jay Powell's talk, and he's going to speak here in about 7 minutes. So got a few things to cover before we get going. Let me see back up. I tried reversals. Well, I mean, you tried. That's all you can really do sometimes is try, and that's the key deal with trading. Just when you don't succeed, come back and keep fighting. Try and try again. And your risk management needs to make sure that you can do that. Today's FOMC, that is the key. But we did have some other things out today earlier. Very briefly run down of the news of the day. MBA 30-year mortgage rate, 6.3%. They're ticking higher. Mortgage applications ticking way lower. What does all of that mean? It means nobody's buying anything. I had a fantastic talk with a trader from Canada yesterday. I was sort of giving me a little bit of the economic outlook from a business owner's perspective up there, and I'm interested. I think that it's the same basic thing we're looking at in the United States. The real estate market is slowing down, and remember, when industry slows down, when real estate slows down, you typically get into a recession type of a situation. Because why? Because people are not spending their money, and if that's the case, we're headed for a recession. And, I don't really see any way around it with high oil prices. We'll talk more about that as the week unfolds. But NBA 30-year mortgage rates, not a good sign if you're in the real estate industry. They spiked pretty good. Why? Because now we're thinking that interest rates are going to be higher for longer. We're almost sure of it. Core PPI was another bad, ominous reading. 0.5% came in for February. This was even before the war kicked off. Bad PPI reading, core PPI, down from 0.8% in January, but still grew at 0.5, much faster than we expected. That suggests that inflation is hot. And when inflation's hot, you typically have to raise interest rates. More on that in a minute. PPI, 0.7% came in way above expectations. Just an absolute dreadful number and a dreadful collection of metrics. Core PPI for the year still ticked higher. You guys know what I'm getting at here. Inflation is up. Guys, these are the February inflation numbers. This is before the war kicked off. This is before you had the big oil prices. This is trouble. This has trouble written all over it. I'm interested to see how Jay Powell's going to negotiate probably what will be a very combative press corps. And now you're starting to see the big downturn right now. Reality is starting to set in for U.S. stocks. The Dow's just off about 500 points now. Interesting stuff. And then we're seeing WTI crude stabilize right around 96. Oof, ugly situation developing. All right, how does the Fed impact the Forex? Remember, a dovish U.S. Federal Reserve suggests what? It's bearish for the U.S. dollar. That means that there's rate cuts coming. We're trying to stimulate the economy. And if we got a hawkish U.S. Federal Reserve, meaning they want to raise interest rates, that's bullish for the U.S. dollar. And let's take a good look at where our dollar is right now. U.S. dollar index. At one point, I was calling for tests at 2021's low down there at 89.20. I don't know that we get there now. I really don't know that we get there now. You got a war to contend with. You have policy that is shifting increasingly hawkish to control the inflation that pretty much everybody knows is coming. Andrea Garwell, good to see you, Andrea. Welcome. The big problem that we have right now is high energy prices. I can't say that enough. I know it's getting tired. I know you're tired of me hearing me say it, but it's the truth. Inverse correlation. Energy prices are up, risk assets are down. What about the dollar? All of a sudden, the dollar starts looking like the dog with the least amount of fleas. A lot of folks are piling into the dollar, as you've seen since this war began. Week 3 of the war, day 18. It's not over yet. The longer this goes, the more it favors Iran, because the energy prices will not come down until you open up the Strait of Hormuz and until we see some stability on the Karg Island and basically the energy infrastructure, which we are getting reports is getting pounded inside of Iran. I don't know where this is going. I really don't. I'll know more tomorrow, right? As will we all. Natural gas is also up 2.75%. The big thing we want to realize here is energy is up and the dollar's up. That's a recession. That's a recession. I'm not going to call it just yet 100%, but we really are starting to lean towards, man, what's going to happen here? It doesn't necessarily look good. Let's go ahead and take a look at what the Fed's going to say today. We sort of knew what Jay Powell was going to say, and here was Fed votes to hold rates steady, notes uncertain impacts from the Iran war. We knew that uncertainty was going to be the deal. We knew it. Data dependent, uncertain. We've got to evaluate information as we move forward before we make a decision. Jerome Powell is not going to cut interest rates before he leaves office. Ain't going to happen. I'll keep rapping. That's just the way that it is. So be very, very careful when you start betting against the U.S. dollar right now. I was a dollar dove. I still am a dollar dove towards the end of the year, but you've got to wrap up this Iran war. It needs to be wrapped in the next 2 weeks unless you're headed for major, major economic issues globally, if we're not already there. That's the number one market driver. That's why being a fundamental trader is difficult, because things can change. And when you start dropping thousands and thousands of bombs and you get a hot war going, all bets are off on our market calls. We just don't really know what's going to happen. And that's exactly what Jay Powell is going to say. In a widely expected decision, the Federal Open Market Committee voted 11-1 to keep the benchmark federal funds rate anchored in a range between 3.5 to 3.75. The rate sets overnight funding costs for banks, but influences a broad range of consumer and business borrowing. Big thing to remember there is, they're not cutting interest rates until at least June. I think July now, and that's a big change in our expectations. Despite the elevated uncertainty, officials again signaled they still expect a few rate cuts ahead. The closely watched dot plot, which reflects individual members' rate projections, pointed to one reduction this year and another in 2027, though the timing remains unclear. There you have it. I think they're going to cut 2 to 3 times this year, but it's not going to be until the end. That's my opinion. And remember, if you want to trade any of these things, these ideas, opinions, strategies, head on over to Switch Markets. They'll get you up and running in no time flat. So you're definitely going to want to check out Switch. If you're new to the room, they've got everything that you need, every market you could possibly need. The big one, we're going to cover some of these things here in a little bit. Gold, look at gold at 4,800. We talked about that washout really developing, and it certainly has. It certainly has. So, all right, let's go ahead and see if we can get online with our interest rate expectations and the man of the hour, Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Jay Powell seems a little giddy. He gets to pass the buck today. Did you hear it? Tariffs, oil prices,
There's been some debate
unreal.
about whether the Fed should look
not
through
my
the
fault.
inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years, and a series of shocks have interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation.
Takes no
forward.
responsibility for unlimited QE.
The thing
No-
that's really
no
important that we
responsibility.
see this year is progress on inflation through a reduction in goods inflation, as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. But and if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs. Going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Ridiculous. He's completely passing the buck. Completely. 17 members in the boardroom, not just me.
Howard Schneider with
He's
Reuters.
getting ready for his
Just to
next
follow up a
job.
little bit and to be clear,
Unbelievable.
Is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've
Bitcoin's
seen
flat
on tariffs,
still.
which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income.
US 30.
And it'll weigh on consumption. But we don't know if that's going to happen.
46,000.
Much lower than
That's
expected
huge.
pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down.
Maybe a little swing
And
high
this is
here in
something
oil?
that people wrote down. We don't debate how long, how do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so
WTI
unclear what
and
the
Brent?
direction from this particular end will be. Meanwhile, the economy
There's Brent.
growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs, and the labor market is the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
I mean, he is passing the buck.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'd be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening, not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate.
Euro USD
it's
falling apart.
It's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we
it's hawkish.
that we do that. Very important.
He's hawkish.
Nick.
Absolutely right. He's the happiest guy in America right now. Gets to completely go, it's not my fault. COVID, a war, it's not my fault.
You've described monetary policy as
It is your fault, Jay.
If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing
This
services
is getting
and
bad.
goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Yeah.
Okay.
Great
So I
question,
would say
Nick.
the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So
Tariffs, the
so
war,
that's
the
coming.
government.
Goods
Government's
inflation
killing
running
me.
at 2%. So that's not coming.
We had a
from
great
standard
plan until
Phillips curve,
the Trump
restrictive,
administration got involved. That's what he's
restrictive
saying.
Policy. It's coming from
This is hogwash.
One runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's
a good question. Now it's his turn to dodge it. Now I'll dodge it.
Sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January, revised down. February,
oil's just rallying.
Is the employment side a far greater risk than the inflation side?
Look at
we
gold.
Are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can
There's your
point
dollar.
to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September.
Ratio.
So that tells you that.
You're getting thumbs down in your
Inflation,
ratio, Jay.
You can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
Great question.
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed.
Wow.
That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality, and I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve.
Or if he doesn't get a better job offer.
And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed, despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just
stocks in a free fall,
low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero,
it's getting bad,
employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
It's directly a result of policy. That's the theme today.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But it has the world changed? I mean, COVID is a one-time thing, right?
Maybe
this energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have
whatever
5
happened to that?
But I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there just
breaking
weren't
green on these oil trades.
Very broad support on the committee, and you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation,
that gold is just cratering.
How much support for a two-sided policy warning would there be?
So it did come
U.S.
up
dollar
today,
index
the possibility
on the
rather,
march.
that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled.
Fertilizer.
How much concern do you
What about
have
ags?
about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate.
Gold is
in any
plummeting
way, and there's
right
really
now.
Not a lot we can do other than
Gold is
kind of
plummeting
watch
because of
and
the
see.
stronger dollar. We'll talk a little bit about it after he's done.
Jerome Powell, Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you said longer-term measures of inflation expectations reflect confidence
This level is
that
going to
the
come
Fed
into
will get
play.
back to its 2% goal. But there are some colleagues of yours who have pointed to higher dispersion in household service and business services as well.
Natural gas?
So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period,
Nice reversal.
The overwhelming
Off of last week's
majority
low for
of
natural
the
gas.
things we look
Boom,
to,
boom.
including markets, including surveys of the public and also
Interesting.
of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of
It's like oil's off to the races.
So people actually wrote up their growth forecast.
We're in pretty good shape right there.
I think that's probably to do with just growing confidence in productivity.
Cut it.
But sorry, and your second question was just
if there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for
Reserve it for the next Fed chair, not me.
Set of circumstances.
I don't have
That's
anything to
not
do
the
with this
situation we're in. What
stagflation.
we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's
It's
just
a
me.
lot like it, Jay, and you know it. The oil shock could really bring everything down.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting?
Good question.
If we have oil prices, above $100 a barrel.
Well, here's our balance in gold. Let's see if we can get this sell.
Is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. With what happens in the Middle East, that's going to be a big factor. And we'll know that then. I don't know how it's going to affect our thinking. I really don't. We did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So,
why did you cut them in 24 right before the election?
Has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen.
This would be an interesting scalp right here.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So
it's a shame we didn't get that sell right there.
I think the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. And So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual.
Nice
good
big
to take
move there.
the forecast with a grain of salt because subject to just very high levels of uncertainty.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States.
Really choppy today.
In a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have, but it's critical.
See if we can get some follow through here.
Do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly,
this question could move the markets.
Gas prices.
The answer could move the markets.
Increase in diesel might drive up food and goods prices and lead to broader inflation.
Yeah, I'm not going to give you an example or a specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that.
Not going to say anything on that one.
You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well, and the effects may not be as big, but they're quite real and they're material.
Yeah, Naomi, he didn't want to answer that one.
Watching it, but it
was a good question too.
And we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
For the last one.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago. And
there's your bid for gold.
And it's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story. If you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Well, thank you, Jay. Heck of a job. A couple of things to cover here before we sign off. That man didn't say anything for about an hour. happy guy just because now the heat's completely off the Fed. The Fed really can do whatever they want. They've got so many shocks going on right now with the Iran war and like the fuel prices. I mean, we were monitoring those positions here just during our live stream, and you could see just how tough it is to step in and sell the crude oil markets at any point in time. Big sell-off in gold. Why is that the case? It's because the U.S. dollar is strengthening. So July 29th right there, you're still pricing in interest rates to be exactly where they are, and you're starting to price in a rate hike. And that should scare everybody. It's going to scare everybody in the markets. How about by the end of the year? This is one of these situations where it looks like I was completely wrong from what I said in January. I didn't see the war coming. I saw us down right around 2.5, maybe 2.25 to 2.5. And now you're looking at a 3.5, and you're still basically saying that maybe one rate cut for this entire calendar year. And this was, you got to remember that we didn't get the rate cuts we thought we were going to get last year. And we got that 0.5 point rate cut before the 2024 election that nobody understands, that Jay Powell will never answer questions on before the election. So clearly what we saw today was a Fed chairman that is I hate to say he's kind of happy, but he's kind of happy because the pressure is completely off the policymakers. They can easily just point at the oil shocks and they can point at the Iran war and say, well, that's the way that it is right now. We don't know what we're going to do because we don't know what we're going, and nobody can know where we're going, and I'm not going to answer any questions. I mean, with that, the last kid that asked the question, or the second to the last guy that asked the question, he says, hey, how high do oil prices have to go before you guys are thinking about hiking interest rates? It's a great question. It's a fundamental question. Jay Powell should have had an answer for that. He should have said, well, it's going to get pretty dire if we see oil prices up around 150 or 200. We may have to do something then. He didn't even entertain the question. He said, I'm not going to speculate or answer that. So we all know what this game's about. It's about oil prices. It's about how high energy goes. We know that energy is going to rise everything in the CPI cart. You'll notice nobody asked him about the producer price index today. They avoided that question like the plague. The biggest thing to remember is this. Federal Reserve chairmen are not going to even entertain the term stagflation on their watch or recession on their watch. He wants to leave office and say, well, I had the most challenging. I had COVID, I had wars, I had tariffs, I had all these things, and we still did a pretty good job managing monetary policy. And in essence, that'll pretty much make him a legend in the space. He'll write the books, he'll hit the speaking tours, maybe even go to work in the private sector. I mean, he really could do anything that he really wants. Might end up being a Treasury Secretary for the next administration. You don't really know what Jay Powell's thinking. The single biggest revelation of this, I don't even know what I would even call that, a press conference. That was just a guy dodging questions. But the single biggest thing that we should take away from this is the statement that I will not leave the post until the next Fed chairman is approved, passes Congress. That may not be a fast thing. You've got DOJ, you got a DOJ investigation into Jerome Powell. That is a situation where Powell says, listen, I'll go ahead and I'll stay on as long as it takes, as long as that investigation is going on, knowing that the administration wants to get rid of him. So the idea is that, listen, you drop the charges and then I'm gone. And is that the right thing to do? Well, if there's wrongdoing there, no, it's not. The charges need to stand as long as the investigation goes. But what happens, and just go there in your mind, what happens if Jay Powell isn't out in May? What happens if he's not out in June? What happens if he's not out in July? He's not going to cut interest rates, not under Powell. This is fascinating stuff, and that's why your markets went a little bit crazy. You saw all of a sudden gold taking a major shot on the chin off about 3%, but more importantly, moving from that 5,000 level. That's huge. You've also got the U.S. dollar index now trading up over 100. We outlined that. We've got equities in free fall. The Dow Jones Industrial Average off about 700 points. It's starting to become very apparent what's happening in this Iran situation. Your energy prices are up. The Fed is not cooperative. They're combative with Trump. It's a problem economically. The Trump administration has some real problems. And I have a feeling that you're either going to have to see a quick resolution to the Iran situation, and I don't know what that looks like at this point. I really don't. But it's all connected, guys, and it's all connected. And if you're not going to get the rate cuts to promote economic growth and you're staring down the barrel of maybe long-term $100 crude oil prices, we're not even in the summer months yet. We could be looking easily, if this situation stabilizes and turns into a 100-day war, something like they're talking about, you're easily looking at 125 static pricing across the board for WTI, even higher for Brent. And that'll be long-term summertime pricing, and it's going to be very difficult to avoid a recession given that scenario. There's no question about what's happening now. So there's going to be a big impetus on getting the situation in the Persian Gulf solved. What does that come right back around to? If you can't get it done with your Air Force and your Navy and the Tomahawk missiles and the munitions coming off of the airplanes, you're probably looking at boots on the ground. They're going to have to get a resolution. The Strait of Hormuz is going to have to be secured. And if there's no deal in place, there's going to be an impetus on getting that secured. And we've been saying it a lot about the 5,000 amphibious troops that went there. That could be a force to take Karg Island, which, in fact, if you took Karg Island, you could hold Iran sort of hostage, saying, listen, we got Karg, you're done exporting oil. Believe it or not, Iran is still exporting oil through the Strait of Hormuz. So there's some interesting things here. It's not really politics. Don't get caught up in politics. And believe me, everybody's got an opinion on Trump. Everybody's got an opinion on Democrats, Republicans. Everybody's got an opinion on conservatives, liberal, Labor Party, whatever. I don't care about any of that. But here's the skinny. Oil prices are up. That's going to put an incredible amount of pressure on inflation. It doesn't look like the cavalry is going to come with the rate cuts until later this year. What if we're talking about back-to-back recessions? We saw the horrible GDP number way below expectations that came in. When those start going negative, then there's a real issue. It's also an election year here in the United States. Midterm elections. It all points to boots on the ground at this juncture. In my opinion, I would call it, I think, by the end of the month, and that'll be an effort to wrap the war up soon. I don't know if it's the right or wrong thing to do. I don't know. I'm not a military. I'm not a strategist. Little bit of a historian, but not a strategist. But that seems to be the road we're going down. Just always remember, it's all connected. It's all connected. So we'll see how it works as we roll on. I want to thank everybody for joining me today. Always fun. The trading wasn't real great. We hit that one gold trade. The crude oil trades we should have hit. I don't know what happened there. Strategy trading. Yeah, right there, Brent gapped up. Crude oil's closing on a high again. Everybody's worried. Euro USD came off. The dollar is surging. You're seeing the dollar surge and energy surge. That suggests escalation in the war. So be watching your news over the next 48 hours or so, 24 hours. I'll be back tomorrow with a live workshop, how to trade crude oil. We're going to be talking a lot about oil, but personally, I may go on and do another live stream tomorrow that's going to address the BOE, the S&B, the interest rate moves from the BOJ that are all coming during this overnight. They wanted to see what the Fed did, and now they're going to react accordingly. So if you're in the Forex, be careful. I've sort of been saying be careful all week. It's been a Fed week. Those are really tough to handicap and really tough to nail from a market perspective. I mean, nobody really had this nobody had this sell-off in gold. Talked a little bit about how it was possible for a big pullback. Nobody had it though, especially given the geopolitical situation, and we are seeing it. So I want to wish everybody happy trading. Have a great session. There's a lot of questions in the live chat that I didn't get to, guys, but we've been going on long enough for an hour. Come on back tomorrow. Let me see. DAH, I'm being modded. No, I haven't modded you. I don't mod anybody. Let's see. What exactly did you say? I tune in these days just for your Powell commentary. Can't wait to see what you have for the next Fed chair. Well, thanks, DHS. I would not. I don't mod anybody. That's for sure. But no, I sure appreciate you guys tuning in. We will be talking a lot about the Fed chairman. We're going to be talking a lot about Kevin Warsh, who's supposed to be the next Fed chair, but I think it could be switched. Warsh may not want the job now that he's got to deal with a war coming right out of the deal. So, nope, we don't mod here. We always do our best to cover everybody that speaks. So my apologies for missing you. I'm sorry about that. Moving fast. We've been going for a long time. So come on back tomorrow. Ask me any questions you want. Tomorrow's the Switch Markets Live exclusive webinar, how to trade crude oil, but I cover that pretty much every day anyways. So we'll talk about that as well. I might fit another stream in, that's for sure. You're absolutely welcome, Naomi. Please do that live. I will do. You're welcome, Marvel. And 512 Eli, good to see you. Hot. What of Bitcoin? I'll cover it tomorrow, I promise. That's for sure. Bobby Bob, good to see you. Thanks. Coach Technical seems not to work this time. Yeah, I mean, the 9 EMA is not real good after these big key events. It's better early in the U.S. session when you're London-U.S. overlap, normal types of things, and maybe even on longer time frames. But yeah, we got hit a little bit as far as this Fibonacci trade. We missed our entry. I should have pulled it. No worries. That's the way it is. All right, everybody, have a fantastic trading day. As always, trade the action well, and we'll talk soon. See you.